Retiring in France in 2026 has become one of the most attractive options for Americans who want European lifestyle, strong healthcare, and long-term stability. But moving to France is not a simple relocation. It requires careful planning around residency rules, taxation, healthcare enrollment, and banking regulations that affect U.S. citizens living abroad. Most American retirees begin with the long-stay visitor visa, officially called the Visa de Long Séjour Valant Titre de Séjour, or VLS-TS. This visa allows Americans to stay in France for more than the standard 90-day Schengen limit and acts as both an entry visa and temporary residence permit for the first year. Applications start through the France Visas portal in the United States. Applicants must show proof of financial independence, housing in France, and private health insurance. The financial requirement is generally linked to the French minimum wage. In 2026, the minimum income expectation is roughly €1,443 per month, although most advisors recommend showing higher income to strengthen the application. Once you arrive in France, the visa must be validated online within 90 days through the French immigration system. This activation process includes paying a government stamp tax of about €200. After the first year, retirees typically renew their status with a carte de séjour, which can eventually lead to a multi-year residence permit and later a 10-year resident card. Long-term residency now includes integration expectations. For many applicants seeking a permanent card, France requires a B1 level of French language proficiency. However, there is an important exception for retirees. Individuals over 65 years old are generally exempt from the language testing requirement. Taxes are one of the most important parts of planning a move to France. The United States taxes citizens based on citizenship, which means Americans still file U.S. tax returns every year, even while living overseas. France taxes based on residency. If you spend more than 183 days per year in France, you become a French tax resident and must report worldwide income. Fortunately, the U.S.-France tax treaty prevents most cases of double taxation. One major advantage is how the treaty treats the U.S. Social Security. For Americans living in France, Social Security benefits are taxed only in the United States and are generally exempt from French income tax. Traditional retirement accounts such as 401(k) and IRAs are still taxable in the U.S., but France gives tax credits when those amounts are reported. Even better, Roth IRA distributions remain tax-free in both countries, which is a rare benefit compared to many other European destinations. However, retirees must still report all worldwide income on the French annual tax declaration, even if the treaty ultimately exempts part of that income. France also applies social contributions on certain investment income, which can reach around 17%. But retirees who are not working in France are generally protected from these charges on U.S. pension and Social Security income under the U.S.-France Totalization Agreement. Another tax consideration is the French real estate wealth tax, known as IFI. This tax only applies to real estate assets. It begins when net property holdings exceed €1.3 million. For the first 5 years of residency, only French property counts toward the threshold. After 5 years, worldwide real estate holdings may be included. Healthcare is one of France's strongest advantages for retirees. After living in France for several months, residents can join the national healthcare system known as PUMA. The system reimburses about 70% of most medical costs, while private supplemental insurance called a mutuelle typically covers the remaining amount. Recent reforms introduced a minimum healthcare contribution for non-EU retirees on visitor visas. That means Americans must contribute financially before gaining access to the public system. Until the registration process is complete, retirees must maintain private health insurance. Once fully integrated, retirees receive a carte vitale, which allows doctors and pharmacies to bill the healthcare system directly. This makes medical care simple and highly accessible across the country. Property ownership is another common question for retirees. Buying real estate in France is straightforward, but the process differs from the U.S. Every transaction must be handled through a notaire, a government-appointed legal official who ensures the legality of the sale. Closing costs for resale properties typically range from 7% to 8% of the purchase price. These costs are mostly government transfer taxes rather than professional fees. For new construction properties, closing costs are usually lower, around 2% to 3%, because VAT is already included in the price. France also offers significant regional diversity for retirees. Provence is popular for sunshine, art culture, and established international communities, although it is one of the more expensive regions. The Dordogne region attracts retirees looking for rural charm, slower lifestyle, and lower living costs, with a strong English-speaking expat community. Brittany offers rugged coastlines and affordability, while Occitanie provides a balance of outdoor lifestyle, good climate, and moderate living costs. For retirees who prioritize healthcare access and global connectivity, Paris and the French Riviera offer the most advanced infrastructure and international services. Financial logistics can be one of the most challenging parts of retiring in France. Because of FATCA regulations, French banks must report U.S. account holders to the IRS. Some institutions refuse American clients altogether. Most retirees open accounts with major banks like BNP Paribas or Société Générale, which have dedicated services for international clients. Americans must also maintain U.S. reporting obligations. This includes filing FBAR if foreign financial accounts exceed $10,000 at any time during the year. Investment planning is also important. Many French investment products are classified by the IRS as passive foreign investment companies, or PFICs. These structures can trigger complex reporting and unfavorable taxation for U.S. citizens. Finally, there are practical details of daily life. An American driver's license is valid in France for 1 year after residency begins. Some U.S. states have reciprocity agreements that allow license exchange without testing. Others require retirees to pass the French driving exam after that first year. The bottom line is clear. Retiring in France remains one of the most rewarding international moves an American can make. The country offers exceptional healthcare, world-class culture, strong infrastructure, and one of the highest quality of life standards in Europe. But the system now expects retirees to be active participants rather than passive residents. Visa validation, tax reporting, healthcare contributions, and financial compliance all require careful planning. For Americans who prepare properly, France offers a retirement defined by stability, cultural richness, and access to one of the best healthcare systems in the world.